Hey folks, Simon here with your daily newsletter for Thursday the 18th of April 2024. What I want to talk to you today is about timeframes, which is an area of much confusion between traders. Some traders will say I'm bullish, some will say I'm bearish, and they could both be right. They're just talking about slightly different timeframes. So what I want to show you here is the chart of the SPY. This is the ETF that tracks the S&P 500. And as I've been saying, it's been rolling over. When we took out the lows of this bearish key reversal bar, that gave the bears the upper hand. We broke the 50-day moving average. We had a kind of later session sell-off yesterday on Wednesday. All of this is looking quite bearish. Okay, this is leading indicator of lower prices in the medium term. Now, having said that, now is probably not a great time to press your bets. Why? Because we're already extended to the downside. How do I know that? Because we're 3 average true ranges below the mean. And what we know from experience is when an index gets down here, it often doesn't have much further to fall. Can it fall? Yeah, it can. But in trading, we're always dealing with probabilities, not certainties. And the probabilities of the market falling further from here are much lower. So what I'm sort of expecting is for SPY to form a short-term bottom, if not today, in the next little while. Maybe we get a rally back up to 510, 515, and then I think the sell-off is likely to continue. I don't think we're going to get a face-ripping short covering rally like this one that we got back in October, November last year. Reason being, everybody was long coming into this sell-off. How do we know that? Well, look, there are several things we can look at, things like commitment of traders and what have you, but one easy one to look at is the put-call ratio. All right, so the put-call ratio is just tells us what options traders are doing. It's not a precise timing tool, but it can give you a heads up as to which way the market has been leaning. Now, when the 10-day moving average of the put-call ratio, this white line here, when that gets down below 0.8, kind of means everybody's long, and that's often when market tops will form. And then you can see everybody was long here, and it took kind of 3 months of pain before we got to a point where everybody's short, and then you get your short covering rally, and that turned into obviously something more important. Again, coming into this topping pattern, you can see everybody's long, and it's going to take a little bit of work before we get everybody gets scared and short again, and it's only when we've spent a bit of time up here that you could start to expect a short covering rally. Now, markets never move in a straight line, and you can see back here the market oscillated. It was in a downtrend, but it moved up and down and up and down. Well, that's the sort of pattern I'm expecting to happen this time. It doesn't mean that's what's going to happen, but that's what I'm looking for. I hope it helps, and I'll catch you on the next update.